Asian Godfathers. Money and Power in Hong Kong and Southeast Asia. Joe Studwell. The only way to break out of the cycle, it was argued, was to increase import tariffs, subsidize industrial credit and micromanage the supply of foreign exchange in order to support the development of native manufacturers. The theory was sufficiently compelling that it had considerable support in international agencies like the World Bank and the International Monetary Fund, IMF. In practice, however, ISI went wrong in one country after the next, at least if judged by the intention to create internationally competitive domestic industry. The reason was that policy was undermined by the traditional, dominant relationship between political and economic elites. Some of the experience has been alluded to in the preceding section, because it was very much tied up with the post-independence agenda of nationalist politics and the backlash against perceived historic Chinese dominance in matters economic. The latter notion, of course, is a myth since it was really big European and American companies that dominated in the colonial period. In Thailand, nationalization began in the late 1930s, but ISI was mainly associated with the regime of Field Marshal Sarit Thanaratt, who came to power in a coup in 1957. At every turn the ISI process in Thailand was built around civilian and military bureaucrats turned capitalists and a small number of ethnic Chinese tycoon collaborators. The tycoons were from trading backgrounds, and this defined their approach to manufacturing. They sought concessions from politicians and the army and then turned to foreign businesses, usually Japanese, to supply them with technology and production processes. Existing manufacturers in Thailand were usually not able to trade up in scale because government projects for import substitution in new industries involved requirements for minimum investment or minimum production capacity that were beyond their means. Instead of incumbent manufacturing firms being assisted by government policy to grow to competitive scale, what happened was that well-connected merchants monopolized deals for protected manufacturing. The norm was for a product's importer to become its local assembler in an arrangement with the foreign supplier. One example is cars and motorcycles, where tariff protection gave rise to manufacturing joint ventures with Nissan, Toyota, Mitsubishi, Hino, Daihatsu, Isuzu and Honda, but no genuine domestic production. Import substitution produced large companies, but it did not achieve the objective of making Thai businesses originate internationally competitive manufactures. By the 1970s Thai industry was a series of big conglomerates dependent on foreign partners, started at different times by merchant tycoons responding to new import substitution policies, in auto assembly, electrical appliances, steel products, glass, chemicals and animal feedstock. Suihiro Akira, airing what has become the key Japanese critique of Southeast Asia, observes, in Japan and in other industrialized countries, technical experts and factory owners frequently became significant contributors to domestic industrial development. In Thailand, there was no comparable development. A pattern of the existing business elite grabbing the fruits of ISI policy was even more apparent in the Philippines. The difference there was that the local elite was rooted not just in trading but, as a result of colonial legacy, in agricultural land. This created powerful contradictions. Well-connected landowners went into manufacturing in the 1950s and 1960s, typically final stage assembly of American products, because foreign exchange allocations, state loans, tax breaks and tariff protection meant windfall profits. But landed tycoons were also exporters of agricultural and mineral commodities who were forced to surrender their export earnings to the central bank to support the ISI program. As a result, they backed ISI in the early, high-return stages, when manufacturing growth was around 10% a year in the 1950s, and then turned against it in the early 1960s. In 1962 exchange controls were lifted and the peso devalued by some 50%. The legacy was tycoons whose interests spread across agriculture, mining, manufacturing and banking who had no particular commitment to any national development strategy. They simply sought concessions. The major landed families that spread into manufacturing and banking under ISI included the Aboitizes, Arenadas, Ayala Zobels and Coancos. The Gokongwais and Palenkas came out of mining. The Philippines economist Timario Rivera writes of a social structure dominated by landed families whose pursuit of a self-contradictory set of interests weakened the constituency for a coherent strategy of industrial growth and development. In other words, ISI was hijacked by the usual suspects. Indonesia, as discussed above, pursued the nationalist Bedtime program in the 1950s, which apportioned most foreign exchange to indigenous traders. The economic historian Richard Robison observes that it created not an indigenous merchant bourgeoisie but a group of license brokers and political fixers. The same would be true in the 1970s when, suddenly flush with oil and gas money, as international prices soared, the government experimented with manufacturing ISI. Licenses and support did not go to small and medium-sized manufacturers, but to well-connected pribumi and ethnic Chinese tycoons. Steel, cement, automotive, chemical and fertilizer plants were again constructed on the basis of merchant traders bringing in multinational firms to provide technology while they concentrated on finessing political deals. Adam Schwartz, a long-time Indonesia specialist, author and journalist, writes of the bureaucratic maze that was created. While many private enterprises with strong political pull did well in this period, smaller firms, buried under an avalanche of credit ceilings and regulations covering production, investment and distribution, suffered. This was the constant in the region. ISI did not nurture small local manufacturers into larger, internationally competitive manufacturers, it simply reinforced the position of the trading-based elite of the colonial era. In Malaysia, ISI policies in the period prior to the 1969 riots saw, for instance, Robert Kwok, from an established trading family, move successively into protected positions in sugar milling, flour milling and shipping through partnerships with Japanese technology providers. Many beneficiaries of ISI protection in Malaysian manufacturing were British companies whose interests in the market had been guaranteed by local politicians in return for an early grant of independence. Chinese merchants in the period obtained important licenses to open banks and gaming operations. After 1969, ISI gave way to nationalization of British and other foreign assets, using windfall oil and gas revenues, many of which were in turn later privatized into the hands of the Godfather elite. Everywhere in the region import substitution industrialization failed to create a tradition of industrial capitalism to complement the merchant capitalism that had been allowed to prosper in the colonial era. Instead, successful merchant capitalists acquired manufacturing interests in joint ventures or technology tie-ups with Western and Japanese industrialists. The pattern never subsequently changed. The Hong Kong and Singapore thing. One of the least helpfully discussed themes in Asian economic history is how Hong Kong and Singapore fit into the overall economic structure of Southeast Asia and, since its policy of reopening to the outside world after 1979, of China, too. This is unfortunate because the region is only properly understood if the special dynamic of these two cities is recognized. The product, as we have seen, of a British imperial and economic quest for self-contained, offshore island bases, the structural roles of Hong Kong and Singapore are remarkably similar. This fact is only obscured by the reflexive description of post-war Hong Kong as a bastion of free enterprise, which is not, with respect to its domestic economy, true, and Singapore as a statist behemoth. Singapore's description of itself as a country, while technically true, is also confusing from an economics perspective. What is important about Hong Kong and Singapore is that they are archetypal city-states, port city-states would be more precise. Since colonial inception they have offered tariff-free trade, with few or no questions asked about what is being traded, and have been places to park money, with few or no questions asked about where the money came from. As relatively easily managed city-states, with highly motivated and purely immigrant populations, Hong Kong and Singapore perform a simple economic trick: they arbitrage the relative economic inefficiency of their hinterlands. In other words, business comes to them because they perform certain tasks, principally services, a little better than surrounding countries. They are both natural deep ports and have long built on this advantage. Hong Kong's immediate hinterland is southern China, but the closing of the mainland to most trade between 1949 and 1979 made the city focus more than it otherwise would have done on business with Southeast Asia. Singapore's dominant hinterland, contrary to the apparent geographic logic that suggests the Malay Peninsula, has long been Indonesia. This is not to say that Malaysia has been unimportant, only that Indonesia has been more important, because it is a relatively much bigger economy. Singapore's trade with Indonesia, focused on Sumatra and Borneo, was greater than that with peninsular Malaysia in the late 19th century, and this continued to be the case in the 20th century. In the 1950s, for instance, almost half Singapore's exports were rubber, and most of this came from Indonesia, often obtained by illegal barter exchange for manufactured goods. So dominant was Singapore as the ocean-going port for both Malaysia and Indonesia in the post-Second World War era that the Singaporean government suppressed much of its trade data in a largely successful bid to avoid unwanted publicity. Hong Kong and Singapore have long traditions as the regional centers of smuggling trade as well as of legal trade. For as long as surrounding countries have imposed tariffs or quotas on trade in their efforts to fund government, Hong Kong and Singapore have profited from circumventing those restrictions. As long ago as the 1860s, the Hong Kong Chamber of Commerce and influential merchant houses like Jardine Matheson expressed outrage when Britain's Sir Robert Hart and his largely British staff took on the running of China's maritime customs service and tried to help the weakened Chinese state raise essential taxes. When Hart began to clamp down on smuggling originating in Hong Kong, he found the Hong Kong government unwilling to cooperate. Hong Kong and Singapore have been at least as important historically as places to store capital, and this role has only increased in recent decades with the development of modern financial services. Ethnic outsider tycoons who have profited from business concessions in surrounding countries have always sought to keep funds offshore, fearing, with good reason, that they may one day be the victims of political change. The possibilities for tax evasion and transfer pricing between different Southeast Asian jurisdictions have also produced vast funds in need of offshore havens. Hong Kong and Singapore's banking secrecy, their willingness to bank the accounts of exotic shell companies with nominee directors, and Hong Kong's exemption of private companies from the need to produce public accounts, have offered the perfect, readily accessible refuge. It was said, for example, in the Marcos era that Hong Kong received a boost from the development of the private jet, simply because Marcos's family and cronies could pop over to their Hong Kong banks for the day. Imelda Marcos did a lot of shopping in the colony. The regional offshore roles of Hong Kong and Singapore have been absolute constants since their founding, and show no sign of change. In the aftermath of the Asian financial crisis, Michael Chambers, head of research in Indonesia for Credit Lyonnais Securities Asia, CLSA, estimated, based on information from banking sources, that some $200 billion of Indonesian capital was sitting in Singaporean banks. That compared with an Indonesian GDP of $350 billion. Some money in city-state banks is legitimate expatriated capital and some is ill-gotten gains. Hong Kong and Singapore show little interest in separating the two. Indeed, in recent years, as the European Union finally brought pressure to bear on Switzerland and other European private banking centers to block tax evasion and introduce withholding tax for some non-nationals, Singapore moved to fill a global, as well as its regional, niche. The city increased account secrecy provisions and changed trust laws in a manner designed to attract the kind of money Switzerland had dealt in. The number of foreign private banks in Singapore almost doubled between 2000 and 2006. After Singapore hosted an IMF conference in September 2006, there was a rare and highly entertaining insight into how some, normally reticent, investment bankers really view the island state. Exasperated by the nauseating pleasantries of the conference and a dinner with Prime Minister Lee Hsien Loong at which foreigners fawned over him like a prince, Morgan Stanley's chief economist in Asia, Andy Sia, fired off a missive to colleagues. People at the meeting, he said, were competing with each other to praise Singapore as the success story of globalization. Actually, Singapore's success came mostly from being the money laundering center for corrupt Indonesian businessmen and government officials. To sustain its economy, Singapore is building casinos to attract corruption money from China. When the email was leaked, a flustered Morgan Stanley spokeswoman said its content was aimed at stimulating internal debate in the firm. Mr. Xie resigned. Together with banking services in Hong Kong and Singapore go real estate, shopping and entertainment. The luxury housing markets of the city-states have always been driven by outsiders. Today it is mainland Chinese in Hong Kong, in Singapore it has always been Indonesians. The Hong Kong or Singapore bolt hole has been a source of security and a reliable investment for tycoons from Thailand, Malaysia, Indonesia and the Philippines, whether in the 19th century or today. After the Asian financial crisis and anti-Chinese riots in Indonesia, the early Monday morning and Friday afternoon flights between Singapore and Jakarta became a tycoon express as ethnic Chinese Indonesia tycoons shuttled back and forth. They moved their families out of their Jakarta homes and into their Singapore ones. Hong Kong and Singapore also have long been the regional centers for luxury shops and fine cuisine, while Hong Kong has its horse racing and the nearby gambling and money laundering fleshpot that is Macau. Though many people expressed surprise, it was not one in terms of historical continuity when the authoritarian regime in Singapore decided in 2005 that it would license 2 huge casino resorts. The post-independence Singapore of Lee Kuan Yew and family has only evinced moral fervor when it does not interfere with the business of a city-state. Hence the contrast between banking secrecy and long-tolerated prostitution, which largely serves visiting businessmen, on the one hand, and Singapore's fines for not flushing urinals or failing to shut the curtains while in a state of undress on the other. Prime Minister Lee Hsien Loong greeted the legalization of gambling with the rhetorical question, "If we don't change, where will we be in 20 years?" But in reality Singapore's casinos are just the latest chapter in its remaining the same. Hong Kong and Singapore were destined to succeed. All they had to do was to be 1 degree more efficient, 1 degree more attractive to capital than surrounding countries and they would prosper. Smallness would be a virtue. This was not always apparent to Singapore's leadership, however.